The stock market is constantly in motion, with individual stock prices fluctuating throughout the day. A concerned scream often erupts when the majority of an index drops unexpectedly. Then why do they happen? What awaits us in the future? In this video, we will dig deeper about stock market crashes and how to avoid them damaging your investment portfolio. Are you new to this channel? Subscribe and hit that notification bell to help us produce more wealth-building content. You can count on Dinero Association to keep you up to date on the latest financial and economic developments. The stock market crash is due to these 6 unbelievable factors. A stock market crash can be defined in many ways. Some say a crash occurs when the stock market or an index loses more than 10% of its value in one day. Others define a crash as a substantial and unexpected decline in the stock market's value and individual shares, usually over a short period. A stock market crash happens when investor confidence or the value of publicly traded assets declines, causing investors to liquidate their positions and move away from active investment into cash or the equivalent. Furthermore, the severity of a collision can be different. The Dow Jones Industrial Average and the S&P 500, for example, both plummeted more than 20% on October 19, 1987, following markets throughout Asia and Europe. The crash was brief, and the markets quickly rebounded. The Dow Jones Industrial Average had recovered more than 43% of its losses in just a few days, and the market had restored over 100% in nearly 2 years. The impacts are broader and more pervasive at other times. The most notable example is the 1929 stock market crash. Stock prices plummeted on October 24 of 1929, recovered briefly, and then plunged again on October 28 and 29. In the end, the market lost 85% of its value. This crash was an essential part of the Great Depression, even if it wasn't the main reason. What causes a stock market crash? Stock market crashes have historically followed extended economic or market booms. Bull markets are powered by economic optimism, steady stock gains, and low unemployment. Prices rise when more equities are bought, individually and collectively. However, prices can only grow so far before reversing in the financial realm. Numerous factors can contribute to a stock market fall, including the following: market panic. Concerned investors sell their shares to preserve their capital. As prices fall, panic spreads, leading to more sales and a crash. There are several reasons why thousands of investors may panic and sell their shares, from a significant market participant going bankrupt to concerns about specific regulations. Natural and man-made disasters. Consider the March 2020 coronavirus collapse. As COVID-19 spread, the prognosis for the US and other countries became bleak. As countries enforced travel restrictions, obligatory company shutdowns, and quarantines, consumers stocked up on essential products, producing shortages. Economic crisis. A crisis in one area or industry can affect the whole economy. One example is the 2007-2008 subprime mortgage crisis. Since the turn of the decade, deregulation has increased the number of high-risk mortgages. When these borrowers stopped paying, home values plummeted, and the housing market imploded. Also, a huge percentage were packaged and sold to institutional investors, who lost billions. Giant corporations where failing triggered a stock market panic. Hey, take a breather there for a moment. If you have not yet subscribed, please click the subscribe button to ensure that you don't miss any of our videos. Here are the 6 factors affecting market crash. Coronavirus. Let's start with the most obvious: coronaviruses and their variations. It has more than a dozen new closing highs this year. The idea was to boost immunization rates in the United States and elsewhere. The likelihood of increased lockdowns, limits, and supply chain concerns, and a potential drop in consumer or business expenditure grows with each COVID-19 edition. In May, the introduction of the Delta variation caused a minor market hiccup, The Omicron form is similar, but we don't know enough about it to convince Wall Street and investors to buy equities. Inflation. Inflation is skyrocketing. Inflation, or rise in the price of goods and services, is predicted in a rising economy. In contrast, the Consumer Price Index for all urban consumers rose 6.2% in October, a 31-year high. Inflation diminishes consumer and business purchasing power. While employees' incomes are rising, increasing rent, home cost, energy cost, and even food inflation may reduce purchasing power. Rising energy cost. Rising energy costs could be scary. Crude oil may spell the death of Wall Street in 3 months. In a conservative perspective, crude oil is the most volatile. Individuals and businesses either reduce their gasoline purchases or pass on the increased expenses to consumers. Conversely, a drop in petroleum prices because of concerns about further variation might hinder job development in the energy sector and harm the overall U.S. and global economic confidence. The oil market must remain stable for the next 3 months. Inflation fears may resurface if the per barrel price rises above $80. Investing in the sector may be reduced if the price goes below $50. Margin debt. Margin debt is terrible in general. It is the amount borrowed from a broker to buy or sell stocks short. While margin can magnify gains, it can also magnify losses. While nominal outstanding margin debt would inevitably grow, the growth rate in 2021 is problematic. In October, the Financial Industry Regulatory Authority reported about $936 billion in outstanding margin debt. This number has more than doubled since the mid-decade. More crucially, margin debt increased by nearly 70% earlier this year. Research says that since 1995, only 3 years have seen a 60% increase in margin debt. It happened in the months before the dot-com bubble burst and in 2021. This is not good news for the stock market. The end of meme stocks. The Federal Reserve produces its financial stability report twice a year, assessing the financial system's resilience and highlighting key near and long-term threats. The U.S. Central Bank recently examined whether young investors buying meme stocks like AMC Entertainment and GameStop could increase volatility and destabilize the market. The paper claims that younger investors have more leveraged household balance sheets. Stock market losses put these people at risk of debt default. The risk link with frequent purchases is also increased, a potentially destabilizing outcome of social media activities, such as spreading false or prejudiced claims on message boards, is also warned against by the Federal Reserve. Valuation. Valuation is frequently insufficient to move the stock market, but when market values hit historic highs, everything changes. The S&P 500's PE ratio was 38 on December 1st and recently touched 40 for the first time in 151 years. The Shiller PE ratio uses a decade's worth of inflation-adjusted profits. To put this in context, Shiller PE has been 16.89 since 1870. But it's not the stock's PE ratio that scares me, because each of the last 4 occasions, the Shiller PE hit 30. The S&P 500 lost at least 20% of its value. Crashing is common when valuations reach extravagant levels. Tell us what you think about this video by leaving a comment below. We are Dinero Association, your partner in building wealth.